Good afternoon, everybody. Just hang tight for just 1 minute here as we let folks kind of filter into the room, and we'll get started in just a second. Okay, we'll go ahead and get things going. Good afternoon, everyone, and thank you for joining us. I'm Charles All, Senior Policy Analyst at the Kentucky Chamber. We really do appreciate everybody joining us here on this Tuesday afternoon. So I think inflation is one of those things that's on all of our minds these days. I know I filled up gas just a couple of days ago, and I certainly felt it. I imagine everybody on this call is feeling it, that discomfort and that anxiety that's coming with higher prices. For employers, this is especially a pressing issue because employers not only feel inflation from the perspective of everyday consumers, but of course you're feeling this as employers who are also purchasers, but also folks who are sort of having to deal with pricing on the other side of the coin. So this is certainly something that we wanted to talk about within the business community. Inflation is one of those things where, despite the prevalence of it in our day-to-day lives, it's also a concept that can be very complicated, very confusing, and of course politicized. And so we wanted to have someone come in and help us sort out exactly what's going on with the economy these days, what's going on with inflation. And we have a phenomenal guest here to talk about that with us today, Curtis Dubé. So Curtis is the chief economist at the U.S. Chamber of Commerce. He tracks the condition of the U.S. economy and analyzes the impact of public policy on economic growth. Before coming to the U.S. Chamber, he worked at the Heritage Foundation, PricewaterhouseCoopers, the Tax Foundation, and you can also see him in various media outlets such as Fox News, CNBC, and C-SPAN. And you can see him cited in outlets such as the New York Times, Wall Street Journal, and Politico. So we are very fortunate that he was able to take some time to talk with us here at the Kentucky Chamber today about what's going on with the economy and inflation. Before I hand things over to Curtis, just a couple of quick housekeeping items. First, we're probably going to go for about 45 minutes or so today, give or take. We've also set aside some time for Q&A. So if you have a question during the conversation today, you can throw that into the chat feature, and then we can ask that to Curtis once he moves through his presentation. So with that, Curtis, thank you very much for joining us here today, and I'm going to turn things over to you.
Thanks, Charles. It's a pleasure to be with you all today. So I will eventually share a slide deck that I'll go through with a bunch of charts. You're all welcome to it. I'll try to put it in the chat at some point. And you're welcome to it. There's notes and analysis in each of the slides. You're welcome to use it for your own purposes. You're welcome to distribute it, to use it however you'd like. So what I'm going to do is I'm going to go through from a high level and talk about where the economy is right now, and then dive into those headwinds that are really a big problem right now. And the biggest one's inflation. We'll talk a lot about inflation, what it means for the trajectory of the economy going forward, and what it might mean for the next couple of days as the Fed tries to tamp down inflation that proved to not be transitory or temporary. I'll leave some time for Q&A at the end. I'm going to go ahead and share my screen. Let me pull up the. There we go. Okay, are you seeing the deck, the full presentation? Got it. Okay, good. Okay, so from a high level, the headline numbers on the economy are pretty good. Economic growth we're looking for 2.5% growth this quarter, and for the remainder of the year. Now we had a negative quarter in the first quarter, which I wouldn't read too much into that. That was a lot of statistical noise. When you look at the core parts of GDP, consumer spending and business investment, it grew by 3%. So that's pretty strong. We had the negative quarter because of big fluctuations in trade flows and a big wind down in inventories from businesses, because we had a big ramp up of inventories at the end of 2021. You take that noise out, it wasn't such a bad quarter back in the first quarter. And now we're almost here at the end of the second quarter, and growth looks fairly good. Also, things like unemployment rate is 3.6%. Wages are growing pretty strongly. Those headline things that people usually look at when they think about where the economy is are in good shape. And yet, if you ask consumers about how they feel about the economy, they feel really badly about the economy. And not only is the economy doing okay relative to those headline numbers, we bounced back really pretty strongly from COVID. We got back to the size economy we had early last year, which only was like a 6-month period between when COVID hit and we lost a third of the economy, and it bounced back to where it was, and we've been growing fairly strongly since then. Now we're not back above pre-COVID trend, which is that dotted blue line, but we'll get there. We'll get there fairly soon. The tendency of the U.S. economy is to grow outside of a pandemic or a dot-com boom or a financial crisis or some major policy mistakes from the fiscal or monetary side. The economy will grow, and it's very resilient. So that's the good news, and that remains the case. But again, consumers feel really bad about the economy. They feel worse about the economy now than they did at any point during the Great Recession, so 2007 and 2009. And they feel worse about the economy now than they did in April of 2020. So when the coronavirus was novel, when we didn't know what it was going to do to our health, we had 24 million people unemployed. A lot of us were locked in our houses. We felt better about the economy back then than we do right now, which is truly rather stunning, again, when you think back to those high-level numbers. But of course, there's good reason why consumers feel that way. And the major one is gas prices. I didn't update this yet for this week. I should do that right now. But I would anticipate that we probably got close to $5 a gallon on average nationally. Here in DC, I paid $5 on Sunday, over $5. That was the first time I ever paid more than $5 a gallon for gas. So I would anticipate that on average, we're at that level. Unfortunately, I don't see a lot of relief coming on this because I think there's just a lot of factors. We can get more into that, but I think demand's going to remain high for gas worldwide, and I think supply is going to remain constrained, and that will keep prices up for the foreseeable future. It may not stay over $5. It might go higher at some point and continue higher, but it might come down. But going back to $2.30 a gallon, where it was when President Biden took office, is not likely in the near future. Now, I didn't peg this to when he came into office to lay the blame fully on him. Certainly, his policies have had a big impact on this, and they are partly to blame. There's a lot of other factors, though. Oil companies are reluctant to add capacity when we're still in a very volatile economic period. It wasn't that long ago that the price of their product was negative, and businesses, of course, have long memories, but it wasn't even that long ago. And we're only a couple of weeks past when a big chunk of China was locked down for the virus. So if you're worried about that happening again, and you have a very investment intensive product like oil that requires a huge amount of investment, and then you have the prospect of the price of your product going negative, you're going to be hesitant to add that capacity, even if you were getting the permits from the federal government. And supply chain issues are hitting oil industry as well. It's hard to get the steel casings necessary to do the drilling. There's a lot of factors, but anyways, I don't see capacity coming on anytime soon to help drive those prices down. It's a problem for consumers. We see this, as Charles was saying, day in, day out, going to fill up. It really puts a squeeze on budgets. It really is a shock to see. We live in DC, so we have a van for our 3 kids that we drive around. But I have this 2007 Jetta I use to drive through the city. And it was $63 to fill up the tank. And it's a small little car and a small little tank. That's sticker shock, and it's happening weekly or multiple times a week for families across the country. And it really does weigh on how they feel about the economy. And I could do a similar chart for food prices. And the same issue is going to happen for food. Food's going to remain expensive and probably go up because of issues with Ukraine, and then gas prices going up, especially diesel. That's going to, and fertilizer prices have gone way up. Food prices are going to continue to remain high. And so consumers are feeling these issues day in, day out. And this is why it's such a political issue. Again, why I pegged it to when President Biden came into office. You're going to see the White House talking more and more about this. And there's only so much they can do, especially because the policies that would help bring prices down, or they're not going to do them, getting more supply going. So you're going to see more of the president going out like he did on Friday and blaming ExxonMobil and other oil companies but that's not going to help anything. But it is a huge political problem when you have such high gas prices.
Hey, Curtis, sorry to interrupt. Folks are saying that they're not seeing the slides advance as you were talking.
Are you seeing it advance?
We see it, but we're not seeing them advance. So right now we just see your first slide up.
Let me just go out and back in of the deck. Okay, are you seeing supply chain issues are finally easing?
There we go. Perfect.
Okay, so here's the thing. The other issue that is driving down consumer sentiment, and it's supply chain issues, which remain an issue for businesses, and it remains a problem pushing up prices. It's going to take a while for this to work itself out. It has been getting better. This is a chart of the number of ships at port at the LA and Long Beach ports. I use this as a proxy for the supply chain. It's getting better. Part of this, though, is that there are fewer ships coming from China as they're still dealing with the lockdowns they had. There's not as much product coming across, but things are getting better as well. Major 103 ships waiting to be unloaded as of January. It's come way down because we are getting more workers. We're getting those ships unloaded, but usually there's zero. Pre-COVID, there was no ships waiting to be unloaded. Now there's still 30, and so it still remains a problem. But what I think the bigger issue when it comes to supply chain is that shortages impact the psychology of consumers, and it makes sense. And I think the latest one really is having a big impact. The shortage of baby formula. Now, U.S. economy doesn't usually have shortages, and if we do, they're short-lived, and they're probably not for such a basic necessity. I think it really matters on consumer psychology to go into Walmart or Target or your local grocery store and see just bare shelves of something that is as basic as baby formula. And I think it really contributes to the feeling that the economy is not in good shape. Hopefully that gets fully fixed in the near future. But just the way things are going, there's going to be something else that crops up just as we move further past COVID. It's really hard to shut down a major economy like we did, and there's going to be other things that crop up and still contributing to that feeling that the economy is not in good shape. Now, of course, so the two big headwinds other than inflation are supply chain, and another one's workforce, which I'll get more into. We have 5.5 million more job openings than we have workers available to fill them. It's an unprecedented situation. I'm sure you're all dealing with it in your businesses. And hopefully that gets better. There's reasons to believe that might get better in the near future, and that will take some pressure out of inflation. But that, I would say right now, it's inflation, workforce, and then the supply chain. So the biggest one being inflation, which, there we go. Hopefully you're seeing, Charles, just nod if you see the consumer prices rose 8.6% annually in May. Got it, okay, good. So not good that it rose 8.6% annually in May, but I'm glad that you can see the chart. Inflation's been high now and growing for a year. What happened in the last few days is that everyone hoped, if you can see that inflation kind of went up it came down in April. It came down from March, and we hoped that we'd hit the top. We'd reached the peak of inflation, it would start coming down. Then we got May's numbers and we went back up to a fresh high, or back to where we were in April. And that's why I'm putting to CNBC on over my shoulder. That's why markets were down significantly over the last couple of days. That's why there's so much more pessimism about a recession coming in the near future. And it really did turn around a whole lot just because of that inflation reading. Now that said, I do think inflation comes down through the rest of the year. I don't think we'll be at 8.6%. I think we'll get between 5 and 6% before the year is done. So I think things will get better, because I do think the workforce issues get better, the supply chain issues get better, take some pressure out. I do think the Fed pivoting hard against inflation will bring inflation down, and I'll talk more about this in a second, because it will buy the Fed credibility, which will impact expectations. Couple things to note though. I'm not sure that I'm not as confident that it will come down to the levels I'm talking about as I was just a couple of days ago. And that's because back to the gas issue, I think energy prices might remain stubbornly high. Food prices will remain stubbornly high, and the run up in housing prices still has not fully been factored into how inflation is calculated. So that means that those things can continue to put upward pressure on inflation. And it doesn't, so you might see a more in-depth discussion about, or people talking more about core inflation, which takes out food and energy prices. I don't think that's going to matter though, because people spend most of their money on food and prices and shelter. And if those things are continuing to be much higher than core inflation, it's not going to buy a whole lot of credibility with the public. So let's talk a bit about how we got to where we are today. Inflation took off March of last year, so we've been dealing with this for over a year now. By the way, there's two ways to measure inflation. One way is the consumer price index, which is the broad measure of consumer prices. That's the one that's over 8.5%. The Fed uses a different measure. This is maybe why they're saying get down closer to, they think 4% for the end of the year. The measure they used was 6.3% in April. We won't get May's numbers for a while. I don't know why they are differentiate. They are so different right now. Some more academic economists will certainly weigh in. It doesn't matter. These are still 40-year highs. We haven't had inflation at 8.3%, the broad measure, since 1981. So, and it would apply for this measure as well. Inflation is really high, no matter how you measure it. And by the way, wages are growing pretty strongly. I mentioned at the top, it's over 5%, 5.5% recently. But when inflation is over 8.5%, it's consumers are losing on an annual basis 3% of their earning power. But so how did we get here with inflation? So it does matter. The workforce issues matter. The supply chain issues matter. But I'm of the school, I'm of the mind that inflation is everywhere and always a monetary phenomenon. It's an old Milton Friedman saying, and I think it still holds true. The Fed lowered rates in February of 2020 to 0. And then in effort to further lower market interest rates and make sure that there was no issues with liquidity, added $5 trillion to the financial system. And that remains in the system today. That's where this inflation is coming from. If we didn't have those other issues with the supply chain and the workforce, and we didn't have the huge amount of fiscal support, which I'll get to in a second, maybe it's 5 or 6%, but it's still much higher than the Fed wants it and higher than would be acceptable. So those other factors matter, but the underlying problem is monetary policy. All this, the Fed needs to get this liquidity out of the system. It needs to raise interest rates to tamp down demand to get inflation back under control. Now it has done that. So what happened here is that they add all the support to the economy to keep the economy from collapsing, stop a financial crisis during a pandemic, and they were successful in doing that. We didn't have a financial crisis. The economy bounced back really strongly from COVID, in part because of what the Fed was doing, and in part because of the huge amount of fiscal support. The hope was that the economy would recover, and with the Fed support, we'd get past COVID, then the Fed could withdraw that support before inflation took off. This was always going to be inflationary. There's no way that $5 trillion wouldn't be inflationary. Everyone knows that. The Fed knew that, but they were hoping for the timing to work in their favor. It didn't. Inflation kicked off in March of 2021, about the time that Congress and the Biden administration and President Biden signed into law $2 trillion of fiscal support. That was after several rounds, several $1 trillion of fiscal support, but another $2 trillion on the pile in March of 2021, when we were starting to recover from the pandemic in a big way. But at that time, so there was a big surge in demand because we were just starting to get vaccines out, but they weren't broadly distributed. So the Fed was really caught between a rock and a hard place. Inflation started to take off. Remember, the talk was, oh, it'll be transitory, temporary. I think they were hoping against hope that was true. But so inflation takes off. The vaccines aren't widely distributed. We're not really past COVID yet. We can go back and look at old charts and show that when virus levels rose, the economy would tank. When virus levels went down, the economy would take off. We were still very much in that cycle at that period. So the Fed doesn't want to withdraw the support because of potential surges in the virus, but inflation is taking off. They don't do anything for basically a year. In November of 2021, they indicate they will eventually change their position in the next couple months. They don't do so until March is when they started raising rates and starting to shrink the balance sheet. That's what this number is. It's called the Fed balance sheet. And so inflation now is running rampant. So the timing didn't work the way the Fed wanted it to, and so we end up with this very high level of inflation. So the criticism of the Fed isn't that they added all this liquidity; it's that they were slow to react when it was clear that inflation was going to take off and be really high. There are reasons why they did that, but the cost of that delay could be a recession or maybe even two recessions. So inflation can cause a recession in two ways. One is that consumers, all of us, we can't keep up with the rate of inflation. Our real spending, inflation-adjusted spending, falls below the rate of inflation, and so our real spending declines. Spending is about 70% of the economy, and you could fall into a recession just because of that. Now, that's not happening yet because consumers are spending really fairly strongly. I can show you real quick why that is. So wages, I showed you that wages are growing, but not as quickly as inflation, still growing pretty strongly, but consumers are making up the difference with a huge amount of savings that they built up during the pandemic. Every month above that dotted line, which was February 2020, all the way through the beginning of this year, was excess savings above pre-pandemic trend. It added up to $2.8 trillion. It's a lot of money still in consumers' pockets waiting to be spent. We spent it down every month this year, but only by a little bit. I think it's like 2.4 trillion left to be spent down. So that will support spending in the near term. Jamie Dimon, the CEO of JP Morgan, said 7 to 9 months of support in savings accounts to keep that spending level higher. So that's the good news in the near term. But in the longer term, how inflation can lead to recession is because of the Fed raising interest rates. And by the way, I just want to hit on this before I get too further in. Expectations matter enormously when it comes to inflation. So when businesses, consumers, and financial markets expect inflation, they act in ways that can cause inflation. So consumers might anticipate higher prices in the future, so they go out and buy a car. That's not a great example right now, or a washer and dryer. Again, not a great example, but again, things are electronics, things that are pricey, things that they might you plan to buy and plan out because they are pricey and more expensive. You go out and buy them in advance because you expect prices in the future. You're moving demand from the future into the present. That increases prices in the near term. You observe prices rising. You say, aha, I was right. Prices are going to rise. And then it kicks off a spiral where inflation occurs because of those expectations. Businesses do the same thing, buying inputs with their own pricing. Financial markets price it in, and you're away and running. Luckily, it works in reverse too. If consumers and businesses and financial markets expect lower inflation, they'll act in ways that can bring lower inflation on. So you delay the purchase of a product because you anticipate the price will come down in the future, or you're just not willing to pay it. That reduces demand in the current period, and that helps bring prices down. So this is why. So I said there's big lags on monetary policy. I do think inflation can come down before the end of the year. So the Fed acts in a credible way and gains credibility with consumers and businesses and financial markets. Those inflation expectations will come down, and that alone by itself will bring inflation down. And they have been coming down. They ticked up the last couple of days, but they have been remained tame. This is somewhat good news, even with the big run up on Friday. But so what I was saying about how does inflation cause a recession? The Fed raising interest rates, higher interest rates reduce demand. It's really not more complicated than that. And when demand comes down, upward pressure on prices comes down as well, and inflation starts to ease. That's not great news for businesses that sell products that people are going to be buying fewer of. Now, demand's been pretty strong. and in a supply constrained environment, maybe that's not the end of the world. So maybe that's good news for businesses, that even if demand comes down a little bit, that doesn't necessarily hurt the bottom line so bad when you're having a hard time filling orders. But it also means that it's very volatile right now. Financial markets are up and down, mostly down big chunks. And this is why, because those markets are really starting to internalize that it's going to take a lot of demand destruction to get really persistently high inflation rates down. And the way this works is that when interest rates go up, everything that consumers buy on credit becomes more expensive. So this is the average rate on a 30-year fixed mortgage. Started the year right around 3%. It's now over 5.3%. That's a huge run up in a short amount of time. You can apply that same run up in interest rates to any type of consumer borrowing. I actually don't think this is going to have that big of an impact on the real estate market. It'll bring the price pressure down. We're up 20% year over year, and that's been the case for a while now in the real estate market. So maybe we don't have a 20% growth rate, maybe it's 10, maybe it's even less, but it's still going to grow because of huge demand for housing and supply constraint, and that you're going to get higher prices. But those higher mortgage rates will take some of the pressure out of that increased price in the housing market. This will apply to anything on the consumer side. So demand for cars, again, supply constraint though, but cars, appliances, electronics, home repairs, boats, trailers, anything that we borrow to spend on will take a hit when these interest rates rise, and that will help bring down demand. Consumers will, they're running up credit balances right now. That's another way. Consumption's remaining high. We spent down our credit balances and paid off debt during the pandemic and with all those savings. So there's a lot of capacity for credit usage, but we're probably you're going to see more of revolving credit or turnover, which means you're using it for everyday expenses, not maybe carrying a balance for some larger ticket items. Same thing applies for businesses. The cost of borrowing to invest has gone up sharply. Same trajectory as the 30-year mortgage. So businesses will find fewer projects that are profitable, and so they'll invest less, and that will take some demand out of the economy as well, again, and help lower prices. Now, until Friday, I was I thought that they had ways to go before this really impacts the real economy. And I think it still applies as we go forward, because rates are still historically low. It wasn't that long ago that a 4.25% corporate bond rate wasn't that high. In businesses, there's enough people still there working. Remember that this is still historically low. Same for a 5.3% fixed rate mortgage. That's still historically low. So this isn't going to start to bite yet. It's back to that expectations that really gets the inflation under control in the near term. But so inflation is going to be with us for a couple of years. I don't see it coming down back to 2%, which is where the Fed wants to be, anytime before 2024. It's going to take a couple of years before we get back to that. I'll wrap up in a few minutes with where I think we go with the economy in the future, but I do want to hit on real quick on the job market. So this is the other major problem, the job opening issue. 5.5 million more job openings than unemployed workers to fill them. There's probably a couple million other loosely attached workers to the labor market, but still a major problem. Every industry all around the country is experiencing this problem of not having enough workers, and it's a major problem. It existed before COVID, but it's become a much bigger issue now. Before COVID, it was a skills and geographic mismatch. The workers available in an area didn't have the skills necessary for the jobs that businesses had available, and they weren't necessarily in the places where businesses were hiring. We've had a big decrease in mobility around in the U.S. That was a pre-COVID issue. That's going to exist post-COVID, but for right now, I put the lack of workers into 3 buckets. I don't know the magnitude of them. I don't know which are the most important. I have a rough guess. But I think when you put all things together, I think you get to the answer. So the first one remains COVID. So people are sick with COVID, caring for people sick with COVID, people with long COVID, people who are caring for people with long COVID, people who have to quarantine because they were near somebody who tested positive for COVID. Those things remain an issue. But the biggest part of that, I think, is the daycare issue. So if you have school-age children, you're probably okay. Our issue here in DC is if the schools are finally open, they finally open in September, but that we don't always have aftercare for everyone. So if kid can't stay at school at 5:30, you think about 3:30, it's hard to work a full day. But the real bigger issue is children who are below school age. The daycares remain not fully open. They're not fully open because of COVID restrictions. So if one kid remember, these are kids who are below vaccination age. One kid gets sick, they shut the whole room down with the teachers and send them all home for 14 days in some cases. This is happening day in and day out to people with children in daycares. So they're in for a couple of days and they're out for 14 days and really can't work in that situation. There's no place to send your kid and you can't, and you're stuck at home. And they're also dealing with worker shortages, just like everyone else. So these daycares are not opening at full capacity, and it's making it really hard for workers with that age children to go back. And of course, this falls mostly on women who tend to still be the main caregivers. So that's the COVID bucket. The next bucket is those savings I talked about. Savings are so high that there are some people who just don't need to go back because they have built up savings, and that's keeping them out of the workforce. Inflation helps on this. Interestingly enough, it's gonna erode those savings balances quickly or more quickly, and those people will have to go back to work to make ends meet. Remember, it's not just the savings too; it's that some major expenses weren't needed to be paid for a year and a half or so. Student loans still don't have to be repaid. So if that's an issue for some people, but then a lot of people didn't pay their mortgages or their rents for a year and a half. So if you're getting huge fiscal support through extra unemployment benefits, that was till September, it wasn't that long ago. That was extra $300 a week at that point, but it had been $600 a week from the federal government. That was on top of everything you were getting from your normal benefits, multiple rounds of checks and not having to pay major bills. Those saving balances really built up, and now people are spending them down. That's keeping some people out of work. And then the last bucket I use is the lifestyle choices or lifestyle changes. Early retirements, people who have left the workforce during COVID and may or may not come back. We want them to come back. They have skills that we need them back in general, but we're tracking that. It's not clear that they're coming back in big numbers yet. They seem to be coming back in dribs and drabs, but we hope they come back in much bigger numbers. And then you have people who are reskilling, people who have taken this time to move from an industry that they weren't particularly happy in, gain different and new skills, and move into an industry that they suits them better. That's certainly occurring. And then I think there's a chunk of people who got involved with their children's schooling when they were on Zoom like this, and decided that they want to be more involved going forward, realize they can make ends meet with one worker in the workforce, and are taking this time to become more involved in the children's schooling. Again, I don't know the major magnitudes of all of these. I do think they add up when all is said and done to the missing 5.5 million workers. So let me we have a few minutes left. I do want to get to your questions and do Q&A, but let me just talk about where the economy could be going in the next couple of years. It's going to be a bumpy couple of years. So even if those headline numbers, if growth remains decent, unemployment remains low, wage growth remains strong, we're gonna have good months and bad months, good quarters and bad quarters. It's just the environment we're going to be in when you have inflation as high as it is, and the Fed having to take actions to wring it out. By the way, I should have mentioned that there is historical precedent for the Fed causing a recession. It's not that long ago. 1981, 1982 was the Volcker recession. President Reagan comes in, gives Volcker the mandate to stamp out inflation. He raises the federal funds rate to over 20%. Remember, we had a terrible time with inflation in the 70s and early 80s. That really high federal funds rate kicked off a very steep recession that lasted 6 months. We rebounded really strongly, had really 5 consecutive quarters of over 7% growth. Growth was really strong through the rest of the 1980s. And we had 40 years of low inflation. But it did cause a pretty painful recession before we had those benefits. So that's where people are getting nervous about the Fed's actions. I bring this up because if the Fed does cause a recession, I do think it'll be short-lived. I do think it would be 6 months at most. And I do think we'd be in really good shape going forward because of all those other issues. The underlying strength of the economy is there. It's really inflation that's the major problem. The workforce issues will work themselves out. Supply chain issues will work themselves out. It's inflation that's the biggest problem. If we get past that, we're in for a period of really strong growth. But again, it's going to be bumpy. There's going to be ups and downs. The market's going to go up and down. We're probably not going to go back to recent highs anytime soon. We'll get there eventually once we're past this period. But it's going to take into 2024 before this bumpy road is over. I said that I don't think we're in store for a recession right now because of consumer spending contracting. I think the chances of a recession for next year and in 2024 are high and growing. A couple of weeks ago, we met with our chief economist committee, chief economists from our member businesses. They put it at the risk at 30 to 50%, with most of them being at 30%. Now, this is before the May inflation number. It seems high, but at any given date, the U.S. economy has a 20% chance of being in recession a year out. So it was elevated, but not yet critical. I think we're probably higher now. I think it's probably 50-50 proposition, probably tipping over into more likely than not, because I think the Fed has to really get that expectations part, to get inflation down now. They really have to act aggressively right now, and that raises the prospect that they'll increase rates high enough that we get a big pullback in demand and we do end up in a recession. I would have given a much different answer just as of Thursday or Friday morning, that I thought we could make it out, again because I thought the Fed had a lot of slack because of how low interest rates have been for so long, and they can gain credibility. But the way that inflation ticked back up and the response we've had from financial markets and just analysts, I think that we're in a much different situation than they were even a couple of days ago. So I'm anticipating the Fed to be really aggressive tomorrow when they raise interest rates. It's not, the expectation has been for a half-point increase. I don't think that's going to be the case. If right now the expectation has shifted to a 75.75%, 75 basis point increase, I think they have to do that minimum to maintain credibility. So that's what I expected at bare minimum. It wouldn't surprise me if they went even higher tomorrow. But again, I'll end on an optimistic note that if we can get past inflation, even if we have a pretty short recession, even if it's pretty sharp, I think we're in good shape after that. And if it was up to me, I would take that pain now rather than in the future. Consumers are in good shape. We have savings built up, unemployment rate's low, wage growth is pretty good. We don't have high debt. This is so 100% different, or 180 degrees difference than we were leading into the 2007, 2009 recession. Businesses are similar, banks are similar. They're in good financial position. If there's ever a time to induce a recession to get out from under the thumb of inflation, I would say now is the time. So I'll stop there and happy to answer questions on anything that I touched on or anything that I didn't get a chance to touch on.
Well, thank you, Curtis. That was great. I imagine this is kind of a unique time to be an economist these days, since you're not only in really high demand, as we're all trying to figure this out, because you would also have to bear that burden of delivering some unsettling news and then also calming our nerves as we try to make sense of the economy these days. I do want to jump into a handful of questions here, some that have been texted to me and some that have come through elsewhere. I want to start with a really basic question, I think. You kind of talked about who is ultimately responsible for dealing with inflation when it happens, and that's sort of the domain of the Federal Reserve. Is there anything that just everyday individuals, everyday consumers should be doing or should be considering in terms of their own personal habits that can either help combat inflation or just simply help cope with inflation? Is there anything out there as an economist that you look at that could be helpful in that regard?
I would say the key thing to do is just brace for a period of high uncertainty and ride it out, and don't act, be forward looking in that we'll get past this. This is a two-year issue. When we get past 2024 or so, inflation comes down, things will be a lot better. Now things can happen in the interim, but there's always unknowns, but the things that will make the situation worse are acting rashly about the latest data point of the day. So if inflation goes up next month, if the stock market tanks for whatever reason, don't be too hasty. That this is a temporary situation. Even though the Fed's made mistakes, there are reasons why they made them. They know how to get inflation down. It's not like we don't know what to do. I remember back in 2007, 2009, there was this big question. No one knew what to do because we had what happened with the financial crisis. It moved from different pockets of the economy. It trickled over in the real economy. No one knew what quite to do other than just to hold tight and work our way through it. And we eventually did, but it took a long time. This is different. We know what to do. We know the way to bring inflation down is to tamp down demand through higher interest rates, and that is going to happen. So that's the key thing. And then again, expectations matter. So if I would expect and anticipate that prices will come down going forward. I don't know when we'll hit a plateau. I don't think we're going to go that much higher than we are right now. So hold off on big purchases to help bring that demand down. The supply constraints really do matter the more I think about it and talk about it. Because if you need a car, you need a car. What are you going to do? Today on the local news, they were talking about, there's shortages of used cars, but now parts are in short supply. So if you have a car and it breaks down and you can't get a part to fix it, now what do you do? So there are issues, that does matter. So hopefully the supply chain issues can get fixed so that we can help get demand down and bring that price pressure down.
There's a strain of thinking in some political circles out there that one of the real drivers of inflation is just quote unquote corporate greed, and that businesses are either causing inflation by arbitrarily raising prices or that they are directly profiteering off of higher prices. I wonder if you could take a minute to respond to that line of thinking and kind of give us your perspective on that argument.
Sure. Yeah, get ready for that. That's going to keep on happening. And the reason is inflation, gas prices, these are a political disaster for any administration. And the worst part is that there's very little they can do. There's very little they can do on the when it comes to inflation. The best thing, so I'll give President Biden credit when he talks about what he's going to do to get inflation down. The first thing he mentions is let the Fed do its job. That's crucial and most important thing. So he deserves credit for that. But outside of that, there's not a whole lot he can do. So he's got to find a culprit. And one of the ones they've settled on is big business. And they hit on, I think it was Exxon specifically. It wasn't just oil and gas. It was Exxon specifically. The president railing against Exxon on Friday. They're trying to pin it on. There were meat producers last year or whenever that was. They're going to keep doing that. I don't think the public buys it. I think they understand that prices are going up for a lot of reasons, and it's not just corporate greed, but it's the best answer they have, and so I think they're going to keep doing it. It rings hollow though, because why did businesses wait? If it was all about greed and it's price gouging, why did they wait now? Why aren't they doing this before? I think the American public's smart enough to know that the markets determine prices, and that there's supply and demand issues that are driving prices higher. And it's not just businesses trying to take advantage of that.
Got a good question here that was just texted to me a minute ago. Something that we've seen in various states, and Kentucky's flirted with this a little bit as well, is doing things like suspending gas taxes in order to keep gas prices lower. In Kentucky, we had a scheduled increase in our gas tax that the governor recently froze. And you've seen other proposals thrown in like that in other states. I think Florida recently did this, for example. I was wondering if you had any perspective on, is that a useful policy approach or an unuseful approach?
I think it helps on the margin. I say this because I was more dubious of it, but then Maryland just suspended their gas tax, and it was helpful for a couple of weeks, and then it came back in, and it was painful. That's the problem. When it comes back in, it's like an extra boost in the price. And so it helps. But it's only a small portion of it. I think it's one of those things where it's just easier to ride it out because the shock at the back end is hard. And then you get demand going up. So you can imagine, so I live in DC, but I would go over to Maryland to get gas. I push up demand. Does that raise prices? You get all these different effects going on. I would say it helps on the margins, but it's not gonna be a cure-all or even a big impact.
Well, great. Well, thank you, Curtis. I think we can start wrapping things up now. Curtis, we really appreciate you taking the time today. Folks on this call, if you enjoyed this or want to watch it again, we are going to post this to our website along with a brief summary. But thank you all for joining us today and sort of learning about this really critical issue facing not only Kentucky's economy, but the U.S. economy as a whole. But Curtis, we really appreciate you taking the time to spend some time with the Kentucky Chamber and talking with their members.
Thanks, glad to do it.
Great. Thanks, everybody. Have a great rest of your afternoon.